Right now, global markets are living in a split reality. On one side, artificial intelligence valuations are soaring to record highs. On the other, traditional engines of global economic growth are stalling out. Moody's Analytics projects that the global economy will grow at just 2.5% in 2026. That is well below the 3% historical baseline that the world economy is typically capable of producing. Geopolitical tensions and physical supply chain bottlenecks, particularly the disruption of commodity flows through vital checkpoints like the Strait of Hormuz, are placing a hard ceiling on economic potential. Yet the headline global data doesn't look like a recession. The massive influx of capital pouring into AI infrastructure is artificially propping up the aggregate numbers, hiding the broader slowdown. This image illustrates the physical manifestation of the boom, a massive surge in data center capital expenditures. Tech-heavy economies are pouring hundreds of billions into these facilities. This chart models a K-shaped economic recovery. The upper arm, driven exclusively by specialized tech sectors like AI and data, accelerates rapidly upward. Meanwhile, the lower arm, representing traditional industries and consumer goods, flattens out or declines entirely. These headline growth numbers mask a reality where capital is increasingly expensive. With sectoral price-to-earnings ratios in growth industries climbing above 60, the growth mirage is built on high multiples that assume the current infrastructure boom can be successfully monetized. This split reality places central banks in a severe bind. They are trapped between sticky, re-accelerating inflation on one side and continuous downward pressure on real economic growth on the other. Standard monetary tools were not designed for this environment. Raising interest rates does not clear a shipping lane, resolve a semiconductor shortage, or unblock a supply chain. Instead, hiking rates simply increases the cost of capital. That directly compresses business capital expenditures and suffocates general consumer spending. Some central banks attempt to raise rates anyway to defend their currencies against imported commodity inflation. But when neighboring economies hike rates simultaneously, exchange rates remain unchanged, and regional growth is universally constrained. This macroeconomic policy stalemate leaves global equity markets highly sensitive to exogenous shocks. Without the safety net of central bank liquidity, any disruption hits asset prices immediately. Traditional monetary policy is paralyzed. For investors, the burden of portfolio protection has shifted entirely away from predicting macro trends and directly onto rigorous micro-fundamental stock selection. To see exactly how dangerous this K-shaped concentration risk is, we need to look at the East Asian semiconductor market. This graph maps the capital concentration within South Korea's KOSPI index. Notice how heavily the retail capital nodes are tethered to just two central hubs, Samsung Electronics and SK Hynix. This structural risk was driven by massive retail leverage. Over 1/3 of the entire South Korean market's margin debt was tied exclusively to these two stocks. When the stock prices reversed sharply, it triggered a chain reaction. The concentration of borrowed money meant a normal price correction instantly became a systemic crisis. Brokers require a minimum account value to maintain margin loans. As the share prices fell, 1.2 million retail accounts dropped below that threshold, triggering immediate margin calls. Investors who couldn't deposit more cash were forcibly liquidated. Roughly 350,000 retail accounts were sold off by algorithms and completely wiped out. The selling pressure spread across Asia, driving single-day drops of over 15%. In a highly leveraged, concentrated environment, excellent corporate fundamentals offer zero protection against mechanical, systemic liquidations. That leverage problem in hardware is compounded by execution risk in software. To justify their high historical valuations, enterprise tech companies have to continuously pivot their business models. Take Route Mobile, a global leader in Communications Platform as a Service, or CPaaS. They manage the infrastructure that allows businesses to send automated messages, emails, and voice calls. Their traditional revenue stream relies heavily on SMS, but standard text messaging is rapidly becoming a commoditized, low-margin utility, creating a direct threat to their historical margins. To counter this, Route Mobile signed a business transfer agreement to acquire Heltar Technologies. Structured as a slump sale, this allows Route Mobile to absorb Heltar's entire operational capability at once. Heltar provides an AI-driven, omni-channel customer engagement platform. Instead of basic texts, their software automates complex workflows across WhatsApp and RCS business messaging, migrating enterprise clients away from legacy SMS and into these AI-native engagement environments is required. It is the only way to deliver the conversion rates and measurable return on investment that enterprise clients demand. Surviving the current technology cycle requires constant, expensive acquisitions. Growth tech investments carry immense, often unpriced execution risk just to stay relevant. We can contrast the systemic volatility and execution risk of the tech sector with the stability of the physical economy, specifically mid-cap industrial stocks in India. Consider Atlanta Electricals, a manufacturer of heavy power transformers for electricity grids. They operate with virtually zero debt, a return on capital employed of 45.3%, and have delivered a 96% compound annual growth rate in profit over the last 5 years. Another example is found in the municipal and industrial water treatment sector with VA Tech Wabag. Their specific economic moat is an enormous 17,200 crore rupee order book. That backlog guarantees 4 full years of revenue visibility, regardless of macroeconomic fluctuations. They pair that backlog with a highly defensive balance sheet, maintaining a 950 crore rupee net cash position for the 6th consecutive year. A third physical economy example is India Pesticides Limited, or IPL, an agrochemical and active pharmaceutical ingredient manufacturer. IPL recently secured a technical equivalence approval in the European Union for its fungicide products. That regulatory clearance acts as a structural catalyst for immediate export growth. Just like the others, they execute this growth with a conservative capital structure, carrying a debt-to-equity ratio of only 0.11. In this part of the economic cycle, outperformance is generated by companies holding massive tangible backlogs and operating with zero reliance on debt funding. The primary contradiction of the late 2026 market environment is abundantly clear. High-growth technology narratives are masking deep structural fragility. The collapse of the South Korean semiconductor index proves that strong macro earnings are secondary when your sector is caught in a structural leverage cascade. To navigate a K-shaped economy safely, portfolio managers have to implement a strict operational framework. First, monitor and limit exposure to margin leverage across index weightings to avoid mechanical liquidations. Second, prioritize companies exhibiting net cash balance sheets. If credit markets tighten, these companies survive. Third, track multi-year Capex order books. A confirmed physical backlog acts as a concrete hedge against global macroeconomic slowdowns. Applying these 3 metrics rotates capital away from sentiment-driven growth traps and redirects it toward absolute fundamental resilience. In a global economy constrained by debt traps and geopolitical bottlenecks, physical assets funded by cash flows offer a stable alternative to the systemic risks of leveraged growth.